Welcome to the Daily Stock Review. Today we're going to review 3 stocks that I haven't reviewed yet, so this is a first glimpse at them. The goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor, just 2,500 hours in over the last 7 years. I'm sharing what I learn along the way. This is my investing process, so today I'll cover how I was screened for these stocks, and then I'll perform a 5-minute check on each to see if they're worth looking into further. These are the guys I learned off. They did pretty well for themselves over just a little while, and by following the breadcrumbs they've left behind, we should be able to follow in their footsteps. If you'd like the free investing resources that I wish I had when I first started, including checklists and all the kind of things that I'm using to screen through all these stocks and value them, you can check them out, link in the description. Otherwise, let's get into it. So I'm using a free screen so that you guys can do pretty much exactly the same. There's nothing special about it. It's just on FinViz. And what I've done is looking for small caps under $2 billion. I'm looking in the industrial sector at the moment. It's just easier to keep that train of thought with the types of businesses that I'm looking at. And then fundamentally, I'm looking at businesses that have grown in sales over 30% over the last 3 years. So at this stage, I am looking for those faster growing companies. Now, I've already been through this and this screen already. Picked out what I thought initially would be exceptional businesses to have a look at. And now what I'm doing is I'm going back through this screen to have a look and see if there's any other gold nuggets in there hiding. So it's a little bit of the case of going through. I've already done a review of American Superconductor. You can see that they had some pretty good performance and had some actual gross margins, operating margins, and then a profit at the end of the day. Some of these other stocks where they've had good growth, they looks like they haven't been able to translate that to anything of use. But that's why we have a look and search for these hidden gems. So today we're going to go over Burner Technologies, Cardinal Infrastructure Group, and I'm just skipping over Concord International, Tianci. I don't, like looking at these, there's nothing really that's stepping out of interest. Circle 8 as well, just going to leave that behind. And CIS is probably the next one of interest, like it's actually showing some positive numbers. But when I've jumped in to have a look at the stock to prep for this video, there's a couple of interesting things going on. Especially, it's got a market cap at the moment of 780,000, which is teeny tiny. So we'll cover that one at the end. So let's jump in. So Burner Technologies, I know nothing about it, but we've done our screen, so we'll just jump into it. Now I want to do this 5-minute check. So first of all, yeah, we can have a look at, I guess, how long this stock's been listed for. It's been around for quite a while, or at least been able to be traded publicly for quite a while. Looks like it's had some fair ups and downs over that time. And if we look over the last 12 months, it's decreased 80%, and potentially a little bit more if you'd bought it different times during that period. PE isn't defined here, so that means that earnings over the last probably the last year was a loss. So there it is, it's undefined here. So what I want to do is jump into the annual report. I've already jumped in and opened that up to make it a bit easier for us and quicker. So I want to have a look at the financial statements. Boom, diddly boom. Yeah, okay, so you're just going to tell me it's a bit further on. Thanks for that, mate. All right, so let's have a look at this income statement. Net revenues. Ooh, so we've got some growth. And it's gone from, what are we in thousands? So 85 million up to 118. We've got cost of goods sold, 30, 46, and pretty good gross profit. So taking home, what's that? If you had 12 fingers, you get to keep 7 of them. So that's a bit over 50% gross, which is nice. Operating expenses, Once they come out, we're not left with too much. Profit from operations is there. And what's our net income? We've got a positive net income. Nice. So 12.7 and 9.6. Looking at the years of 2024, 2025. So it's pretty good. Net income of 9 million from 118, and the previous year 80 or 12.7 against 85 million. So we're talking about that net income, net margin of, around that 10%. That's fairly decent. There's a fair bit of costs here. Those operating expenses have grown pretty much, in lockstep with the net revenue as well. What did it say out here? What are you going? It's got a market cap of 90 and a PE, which is undefined. So unless they've grabbed that from somewhere else in the quarterly financials, that's interesting. So this business at the moment, it's had this 80% drop in price. So, last year, this report came out in about this time. It's dropped it significantly, and we're talking it made 9 million net last year against a market cap of 90, so that's 10x. So pretty low. Let's go and have a look at our balance sheet just to see if this is, a ticking time bomb of debt that's going to implode. And, we've got assets, we've got cash. Liabilities wise, what do we have? Deferred revenue, operating lease. So it's just got future payments that are going to come out. It doesn't appear here straight away that there's any big debts or anything like that, or any imminent bankruptcy that's going on. So that's interesting. It has an accumulated deficit, so this business probably hasn't been producing profits for a while, and so it's been producing a loss in past years. So we've got to take that on board. So that may be another reason why it's, not being favoured. Now let's have a look at the cash flow statement. Really, I'm looking here for if this business is actually making cash. Now, we've got our income statement, or net income at the top. And we get this number down here. So they take away non-cash charges and other adjustments that come out through the year. And we end up, the business made 11 million cash last year, but it hasn't made any cash this year. So it's actually used up money. So let's just go line by line, just looking for any big differences. So that has gone back into the business, these positives. And then we've got some big lump sums. We've got inventory. So significantly more inventory, and we've got significantly more accounts receivable, which has come out, which has wiped out our free cash flow at the time that this report was done. So this is a snapshot in time over the last 12 months to see where the money's gone in the business. All right. So we expect this to be pretty lumpy, the amount of cash flow from the business. But let's have a look at what else is going on. So the business has property, plant, and equipment that it needs to actually invest in, which previous year was 2.3 mil. Most recent year is 7.6. All right. So, last year they had a fair whack. What else have they done? Last year they invested that money into marketable debt securities. So that would be things like potentially other bonds and things like that. Might be other corporate bonds. It could be anything. All it gets lumped under is that. They may have additional info in the notes to financials. But this is something that they can exchange or withdraw that cash in the future. You can see proceeds from sale of marketable securities, debt securities. Last year they put their money in that just to store it, And this year they've taken that money out to pay for purchases of property and equipment and for the fact that they didn't have the cash flow this year. Acquisition of federal firearms license. Ooh, $6,000. Nice. Purchase of patent rights. All right, what else have they been doing? Repurchases of common stock. Ooh. That's always a good sign to see. As long as the business actually has the money, which in the previous year it did, so it did a bit more. And this year, or last year in 2025, the money that they had from... Actually, they've whittled down their cash position by the look of it, because we've started the year with 16.8 mil and ended the year with 13.7. So interesting. Obviously, we don't have a third year here. We just got to make our initial assessment on that. Otherwise, we spend too much time. Now, is this a business that is going to 100x in terms of the revenue that it's making? At this stage, look, the growth rate is pretty low. The business doesn't have to invest too much in it, but it has put a fair whack in this most recent year. So we'd want to be seeing some positive return on assets. We want to see some cash flow in this future year. But just having a look at what the market cap currently is, this is really priced in, and if the results over the last few quarters are pretty terrible, look, we got net income here of negative 10 mil, revenue of 16 for the quarter, net profit margins down. So there is some pretty ordinary news coming out. How does... Alrighty. So, yeah, there's some pretty poor news coming out. We really need to be assessing if this business can actually weather the storm they're currently in. And if it can, there may be some significant upside. But at this stage, does this business fit my look for 100x stocks? Not at the moment. It definitely has potential to increase a fair bit if it can show that the business has got some revenue growth. But at this stage, the news looks pretty ordinary. So let's move on. Cardinal Infrastructure Group. All right, what are we looking at? Sure, business has been around. It's been listed since December last year. Now, this is an interesting one. So the stock did decrease in price after it was listed or able to trade, but it's gone up pretty quickly. And if we look, it's come back down. I guess expectations and investor sentiments changed. But what we're looking at here is we've got a PE ratio about 26, where it is right here. Now, if we look in the last month, it's dropped a fair bit, 44%. Now, what else can I see here just on this screen? Cardinal Infrastructure Director Anthony Wood Jr. buys 2 million shares. Okay, so when insiders in the business buy, there's many reasons why you sell a stock, but there's usually only one reason why you want to put your own money back in. And it's because you're pretty confident that it's going to do better being invested in the business over the long term. So that's usually a pretty good sign. But let's have a look at the financials and see if this business has actually got some legs. Sure, I might have to enhance on this one because this is like miniature. All right, financial statements, supplemental data. Thanks, boys. All right. wonder if we can zoom in a bit more for you. For the boys and girls at home in the back seats. All right. What do we got? Statement of operations. So that's also known as our income statement. And what can we see? Revenues, 247, 315, 456. Ooh, nice. So this is in just, it is what it is. So it's not in thousands. That is actually 247 mil, 315, 456 million. Cost of revenues, looks like it's gone up. General and admin. So we got 6 to almost 24. So there's 4x in general and administrative costs. That's not really a good sign, especially when we look at, cost of revenues, 247 against 200, so 47 mil. 249 against 315, so 65. And then, we're getting up there now. It's like almost 100 million. So you're getting a little bit more margin on that, but it's getting wiped out. Like this growth rate of general and admins creeping up faster than our revenue growth. So that's something to be mindful of. Amortization, don't care. Income from operations has gone up. Yep. Net income, 24 mil, 28 mil, 31 mil. So even though our revenue has doubled, let's just call it a double in 3 years, 247 against 456, it's a bit under that. That's not 500 million, but we can see that our net income hasn't doubled in that time. These other costs and things like that have eaten away at it. Now we do have this amortization expense, these non-cash charges. So it's going to be interesting when we have a look at the cash flow statement. So nothing to write the business off yet with. Let's just have a look at what we're talking in terms of assets to liabilities. So total liabilities, 251 mil against 394. They got a heap more assets and a heap more liabilities from the previous year to now. From 140 million up to 394 for the assets, and 116 million to 255. Now, let's just have a look at the debt. Notes payable less current portion, net of unamortized debt issuance costs. Ugh. All right, so they've racked up a bit more debt. Accounts payable's gone up, and other bits and pieces like that. Cash position has gone up. So the amount of cash that they've got on hand is 97 million. They can almost pay off, they can pay off all their current liabilities. So that's pretty good. But they've also still got this debt here. So we want to check out the cash flow statement and see if they can service all this debt in the future. Even though revenues have gone up, like I said, the net income hasn't gone up in lockstep. So as long as, if we can see the business is investing and the cash has grown quickly in the business, that's a good sign. Or is it investing in its assets and spending that cash, which is a good long-term play and is usually a good benefit to its moat, its competitive advantage over time. All right, so net income, 24 to 28, 31. We've got our adjustments on here. So we've got these amortization. Have in other intangible assets. We've got non-cash stock compensation, so that goes back in. Now, contract assets. Accounts payable. All right, so there's a fair bit of money floating all around here. So contract assets, if we're looking and doing a deep dive on the business, we'd want to see what this is going to be long term to try and normalize it, to try and figure out what this net cash provided by operations is more normalized. You can obviously see it's gone from 30 mil to 42 down to 30 or 38, but we do have some significant costs and like cash that's getting used up back here and then obviously coming back in. So we've got to be mindful of that. Now, where does this business actually have to invest its money? So free cash flow is net operating cash. So this figure up here minus the purchases of property and equipment. So 30 minus 12 gets us 18 million, 42 minus 20 gets us 22, and then 37 minus 43 gets us, minus 5. So they've had some significant investments in property and equipment in this recent year, which may be out of the ordinary, and we've got to figure out if that's capital expenditure for the maintenance of the business or for the growth. And so doing a deep dive, you can usually see if there is a breakdown in the notes to financial statements. Sometimes they do have it, sometimes they don't. So this business makes, if we just look on the previous years, 10, almost 20, pretty much 20 million in cash. It does, like, after, paying for these bits and pieces. Where else has it financed the business? Oh, golly gosh. There's a fair bit going on here. So proceeds from notes, principal payments of notes, you buy and you sell and maintain your cash position. 26 minus 26. Proceeds from equity offering, net of underwriting discounts. So they've propped up, they've done a lot more investment in the business, raised their cash position, etc., and their assets by having that equity offering. Repurchase of outstanding equity, Cardinals OpCo units. So there's 100 million here that's gone into bits and pieces from that underwriting. Then, depending on just reading through here, it looks like the business is paid off. Part of it's either previous ownership or however that was structured. So then it's a kind of recapitalized part of the business. Now, interesting. Yep. Like, obviously it's been listed, so that's kind of where the money's gone. They've invested, an extra 20 million pretty much in property and equipment, which we should see some benefit of the business in the future. And if we go back to the this business's prospectus, that might be interesting to look at and see, have they actually done what they said they would. So business is making 20 million in cash with some growth. Look, I think at the moment, you have to have a look at like the earnings and see if there's going to be a big change here, but I haven't seen the efficiency in this business that I would like in terms of it converting more to cash over time. It may be that I'm too early to look at this business for my obviously look at it, but at this stage, what would happen if at 100x it would be $100 billion company, and the valuation at the moment probably is around that, expecting a bit of growth, but it's not expecting a huge amount. Now, the insider buy is interesting. It'd be one to keep an eye on if you're looking at a reasonable compounding business, but you'd need to do your homework. All right, so at this stage, it's not meeting the criteria for me for the 100x. It may in the future, but we'll go from there. All right, so C3IS Inc. with a ticker of SIS. So, like I said earlier, this one's had a pretty rough trot. I don't know how it was structured and got onto the exchange, but a 100% loss according to the old Google. Either dilution or something's going on. And if we look at where are we? Oh, it's just into December. So December last year, we've had a significant drop in the value or price of the stock, going from 245 down to 30. So that pricked my interest in the stock to just have a quick look at that before going into it. And what they did is they had another underwriting of shares onto the market, and in effect, like without going and trying to value part of it, it's diluted the value of the business in that time. All right, so where are we at? Year to date, stocks obviously continued to come down further and further and further. Still a 99% drop since like January this year. 6 months, still a 99% drop. It's literally, dropped to nothing. So really, really, really interesting. All right, let's have a quick sticky beak at it. Let's not write it off just yet. So to come up with this, I had to go on to Edgar, find because it is a foreign business which is listed on a US exchange, it is a file 20F, which I found, but you have to look through here to find the little bugger. And then, yeah, there it is. Annual and transition report for foreign private issuers. We get this bad boy. And let's have a look at the financial statements like we usually do. However, it's kind of listed in a slightly different format. So let's see if it is how I want. All right. Yep. Let's have a sticky beak. All right. So we got 2023. We got revenues from 28 mil to 42 to 34. We've got expenses. Let's just go total expenses and income from operations. So we've got 10 mil, 10 mil, 1 mil. Oof. What's going on here, boys? So I guess all these fixed costs that they've potentially had, they haven't had the revenues in that time, which has chewed up their margin. And then what do we end up with? Net income or loss. So it's made a loss. It's made a loss. And then the most recent year, it's made a profit. Wow. Interest and finance costs. Am I looking at the right line or am I tripping? No, I'm not. Net income. 9.2 mil. A loss in the previous year and a gain here, but it's loss gain on warrants. So note 8 might be interesting to have a look at. So depending on those warrants, it might be like actual businesses hedges and using financial instruments that are making the business stay afloat and have some money. Balance sheet. Let's have a look at what we're looking at. 100 million versus total liabilities of 29. All right. And that's significantly less this year. Why? Payable to related parties. So current liabilities is down. And warrant liability is wiped this year as well. Interesting. All right. So it does look like the business is slightly better off this year. Doesn't look like they've got too much debt here. Well, total liabilities being $3.3 million against previous of 30. So I guess on first appearance, it does look like there's less risk this would go to zero at this point in time. Now let's have a look at the cash flow, because this is a bit more telling for how the business is actually staying afloat. So we've got our net income, net increase, decrease, net cash provided by operating activities. So we've got 5.6, 24 million, and then 4 million in the most recent year. And we know it's going to be lumpy, but that is a fair bit. And it's these loss or gains on the warrants which are coming through. So previous year that added to it. Most recent year it's taken it out. So cash positions pretty fluctuating. Payments for acquisitions and capitalized expenses of vessels. So there's a fair bit that this business needs to invest in. Back here, they didn't do much in the previous year. It looks like they've held onto that cash. Just pretty much transferred it between there, just maintain position and increase in bank time deposits. All right. Proceeds from former parent company. So previously in 2023, where are they ended up? Net cash provided by financing activities. So they propped the repayment of seller and capital expenditures financing. So most of their money's got plowed into capital expenditure financing for this year and last year as well. Their ending cash and cash equivalents at the end of the year. So last year they had 4.6. This year they're ending it with $600,000. That is a pretty ordinary position to be in. So what are they going to do? So they've had to fork out. They've had a pretty rough trot. They didn't get the revenues they thought they were going to, and that was down. They've then had to repay these seller capital expenditure financing. I guess otherwise they lose those bits of equipment and they're forced to either provide them back or, depending on that arrangement, there's potential that it could be used to force the business to go bankrupt and then sell the assets and everything on back to the seller and whoever's holding the financing for it until they get payment. So that's a potential. So what are these guys going to do? It doesn't look crash hot. The business doesn't fit my criteria for the 100x. So really it's more of a value play if you guys are looking at it. And really you're trying to see how bad is the situation in reality? What's the business going to do? Is it going to make a profit in the future? And if it does, what's your slice of the action for it? So this could be a nice value stock, or it could be, we talk about catching a falling knife, or is it just a value trap at the end of the day? So business-wise, I don't know, it's not showing that it's got a strong moat around it, which is risky as it is long term, and you'd have to look into it that way. Now, does this fit any of my criteria? No. So we've had a rather unsuccessful day. We'll be back at it tomorrow. But Burner, Cardinal Infrastructure, and Sis, they're obviously two of them are on a really rough trot. But really going through this is just showing me that the most fertile ground from the screen that I had was to obviously trust businesses that had margins making their way down to the bottom line of the business, which they've been the most interesting stocks to have a look at. Let's just put it that way. And that most of them have made my requirement to go and do a deep dive on them. If you'd like to check that out, you can check out the other link in the description. That's where I house all that additional research and the curated list of those stocks. And otherwise, if you guys are interested or you've already invested into these companies that we've gone through today, feel free to drop us a comment below. Let us know what your rationale behind it is. And if you guys are long-term investors, let us know. That'd be sick to see what you guys are looking at and what else you guys can see. All right. Otherwise, check out this next video or this playlist because I think you'll like the playlist and YouTube thinks you'll like this video. Cheers.